The global energy transition and the artificial intelligence revolution have just collided with a hard physical barrier. This month, copper prices surged past $11,000 per metric ton, touching multi-decade highs and sending shockwaves through commodity markets. However, this price spike is not merely another cycle of speculative trading. The underlying data points toward an alarming reality that the global economy is running out of the raw copper needed to build the 21st century. While previous decades were defined by geopolitical battles over crude oil, modern economic dominance hinges on the physical metal lining our power grids, transformers, and data centers. Between decaying 20th century mine outputs, an unprecedented wave of dense AI facility construction, and a decade-long development process to open new mines, energy analysts forecast an unavoidable 5 million ton structural deficit as we approach 2027. Welcome back to Earnings Per Page, where we analyze complex financial trends and business literature into actionable frameworks. Today, we unpack the critical structural data driving the global copper supply squeeze, explore why the race to electrify society is hitting a logistical wall, and examine what investors must know before the 2027 fiscal cliff. To understand why copper prices are breaking decade-long records, we must first look at the deteriorating condition of the world's primary supply chain. Over 45% of the world's mined copper originates from South America, anchored by aging, massive mines across Chile and Peru. However, these legacy operations are experiencing severe ore-grade decline, a geological reality where each ton of extracted rock yields lower concentrations of usable copper. 30 years ago, processing a ton of rock yielded nearly 2% pure copper, but today that yield has dropped below 0.5% across major deposits. Consequently, mining conglomerates are forced to crush, transport, and process 4 times as much raw material using significantly more water and power simply to maintain their existing baseline production. Compounding this extraction efficiency loss is the fact that global warehouse inventories across major exchanges like the London Metal Exchange and COMEX have fallen to dangerously low operational buffers. When global physical reserves run thin, spot commodity markets become hyper-sensitive to minor localized operational freezes, whether caused by labor disputes in South America or regulatory mine closures in Central America. The baseline supply chain is operating at maximum capacity, leaving zero margin of safety as global demand accelerates. The demand side of the copper equation is accelerating faster than traditional economic models ever predicted due to two twin forces: transportation electrification and the artificial intelligence compute expansion. A conventional internal combustion engine passenger car requires between 20 to 50 pounds of copper for basic electrical wiring and components. In contrast, a battery electric vehicle requires roughly 180 to 200 pounds of refined copper to supply its high-voltage battery architecture, electric motor windings, and internal busbars, representing a fourfold increase in copper intensity per unit. Simultaneously, the rapid expansion of generative artificial intelligence hardware has introduced an entirely new tier of structural copper consumption. Traditional cloud computing data centers operate on moderate rack power densities, but next-generation AI clusters demand massive high-voltage transformers, heavy-duty power distribution units, and liquid cooling cold plates built heavily out of high-grade copper. Market intelligence reports estimate that a single gigawatt-scale AI factory consumes tens of thousands of tons of refined copper just for initial installation. As tech giants deploy hundreds of billions of dollars into building out compute infrastructure over the coming 3 years, the tech sector is placing an unprecedented demand load directly on top of an already strained global electrical grid. In commodity markets like shale oil, high prices incentivize swift domestic drilling responses that can bring new supply online in a matter of months. Copper mining operates under a completely different temporal reality, where bringing a new greenfield copper deposit from initial discovery to commercial extraction takes an average of 10 to 15 years. Developing a Tier 1 copper mine requires billions of dollars in upfront capital expenditure, extensive geological surveying, complex water access rights, regional power infrastructure development, and multi-year environmental permitting reviews. While environmental, social, and governance frameworks are essential for sustainable land management, they have naturally lengthened the timeline required to clear regulatory hurdles across North and South America. Projects discovered in the mid-2010s are only now coming online, while exploration projects discovered today will likely not yield commercially refined copper until nearly 2040. This inherent multi-year development lag means that global mine supply over the next 3 to 5 years is effectively locked in place, proving that financial capital alone cannot immediately overcome physical development constraints. Because copper is the foundational metal for power transmission and modern technological hardware, it is shifting from an ordinary industrial commodity into a critical strategic national asset. Major world powers are moving away from open, market trade frameworks towards strategic resource nationalism, actively competing to secure exclusive mining rights and off-take agreements across South America and Africa's copper belt. Furthermore, smelting and refining capacity represents a major industrial bottleneck where China currently processes roughly half of the world's refined copper supply. Just as Western nations recognize the systemic risks of concentrating advanced semiconductor manufacturing in a single geographic corridor, governments now realize that relying on centralized foreign refining capacities leaves their domestic defense, green energy, and technology sectors highly vulnerable. As a result, sovereign nations are beginning to build strategic metal stockpiles and engage in direct resource diplomacy to secure copper supply agreements ahead of projected 2027 structural shortages. As we look toward 2027 and beyond, the fundamental data shows that structural supply deficits will continue to widen unless capital investment into new mines expands rapidly. While industrial substitution toward metals like aluminum is feasible for long-distance overhead power lines, aluminum's lower electrical conductivity and thermal limits prevent it from replacing copper in high-density AI transformers, electric vehicle motors, and microelectronics. Scrap metal recycling continues to provide essential market liquidity, but recycled copper currently satisfies less than a third of global usage and cannot scale fast enough to bridge a multi-million-ton structural shortfall. Ultimately, copper scarcity will dictate the practical speed of global innovation, forcing technology companies, automotive manufacturers, and energy grid operators to adjust their strategic roadmaps. Thank you for tuning in to Earnings Per Page, where we save you hours of technical research so you can retain the actionable insights. Be sure to subscribe to the channel for weekly deep dives into macroeconomics, personal finance, and wealth creation, and leave your thoughts in the comments on how you are positioning your portfolio for the upcoming commodity deficit.